In this video, I will go through a problem from the end of chapter exercises. Problem 213A. It's right here. And this problem is a good summary problem to illustrate how to account or how to journalize various transactions that happen within a given period. In this case, we have a company, Artsy Graphics. They're a firm that provides designs for advertisers and market analysts. So they're a graphics firm. And there's a series of transactions during the month of July. Here we go. So there's a series of transactions that happen during July, and there's 14 things here. We're supposed to, well, you can see what it says in A and B, but what I want to do is just journalize each of the transactions and then update the T accounts and then prepare a trial balance. So I guess A would be journalize the transactions, and then B would be update the T accounts, and then C would be prepare a trial balance. So you can see as of July 1st, the beginning of the month, they already have 6 different accounts on the books. So 6 T accounts. Each of these accounts already has a balance in it. You see it says on July 1st, the business's general ledger showed the following accounts with their normal balances. The word normal just means an account's normal balance. It's what does it, so for example, if we go back to the previous video, that acronym DEA-LOR, so the DEA accounts, those are all increased with a debit, which means any D, E, or A account has a normal balance of debit, a normal debit balance. So normal means what does it take to increase the account's value, a debit or a credit. So the DEA accounts have all normal debit balances. And the LOR accounts, for those accounts, remember to increase their value, you have to credit them. So those have normal credit balances. So we can write down the T accounts, these 6 T accounts here. So cash. So at the beginning of the month, we have cash sitting there, and it has $6,800 in the account. And again, is it cash, D-E-A-L-O-R? It's an A, it's an asset. And we know assets are increased with debits. So cash has a normal debit balance. So this $6,800 is over here on the left-hand side. That's the balance at the beginning of the month. Accounts receivable, $10,700. That's $10,700 over here on the left-hand side again. Debit side. Accounts payable. Any account with the word payable in it is a liability. So that helps. And we know liabilities have normal credit balances. So account payable is $2,100 sitting over here as the balance on July 1st. And we have notes payable. And then common stock. And then retained earnings. I'll just abbreviate it, retained earn. And notes payable is $4,200, credit balance. Common stock, $2,000, credit balance. Retained earnings, $9,200, credit balance. All right, so that's what we have as of July 1st. The sum of the debit balances equals the sum of the credit balances, and the accounting equation is in balance. Total assets equal total liabilities plus total owner's equity. Now let's journalize each of these transactions using the 5 steps or the 4 steps that we went through in the previous video. Before we do that though, let's talk about what an expense is, because several of these transactions involve an expense. Expenses are often tricky for students. So an expense, according to generally accepted accounting principles, GAAP, expenses should be recognized or recorded. Recognized means recorded in the form of a journal entry. Journalized. Should be recognized when they are incurred. And the question is, what does it mean for an expense to be incurred? When is an expense incurred? Because if we answer that question, then that tells us when we need to recognize it. Because GAAP says expenses should be recognized when they are incurred. So an expense is incurred when the company derives a benefit from using an asset. Or when an asset declines in value. That's one way to think of it. So expenses incurred when company derives some benefit. I should say some benefit from using an asset. And on the flip side, for the sake of completeness, revenues, according to GAAP, should be recognized or recorded, a journal entry made, when they are earned. Expenses are recognized when they're incurred, and they're incurred whenever the company derives some benefit from using an asset. Revenues should be recognized when they are earned. When are revenues earned? So when is revenue earned? Revenues are earned when the company provides the goods or services to the customer. Provides goods and or, if it's a service company, services to the customer. All right. With these two things in mind, we can go forward with this here. So the first transaction, paid July rent, $510. Let's journalize that. We're going to have to assume something, though, to make this make sense. And then we'll change our assumption in chapter 3. But for this chapter, let's assume that whenever the company is paying for something like rent, utilities, salaries, supplies, that they're deriving the benefit from using the asset right whenever they are actually paying the cash. And that assumption is not true in general. For example, number one, companies usually will always pay rent in advance. So July rent is paid on July 1st. and they're not deriving the benefit of their rent until July happens when they actually can rent the space. And they technically shouldn't recognize the expense according to GAAP until at the end of July, after they recognize or derive the benefit from using the space. They pay for their rent at July 1st, but they don't derive the benefit from using the asset until the end of July. So the expense shouldn't be recognized until the end. But to make things make sense in this chapter, we're just going to assume that whenever they pay the cash, that's when they derive the benefit from using the asset. According to GAAP, you should recognize the expense when it's incurred, and it's incurred when you derive the benefit from using the asset. So here we're just we're going to kind of assume that they paid the rent at the end of the month, and they've already derived the benefit. So we would debit. The two accounts involved are rent expense and cash. And I guess I'll go through those 4 steps that we introduced last time for this first transaction, and then I'll kind of take a shortcut and just write down the journal entry for the rest of these. But I'll walk you through the steps verbally. But for this first one, the first step, remember, is which accounts are involved. Rent expense and cash are the 2 accounts. And for each account, identify what type it is, or identify does it go up or down. Rent expense should go up, cash should go down. Rent expense is an asset. Rent expense is an expense. Cash is an asset. And then we use the rules of debit and credit from the video. So dividends, expenses, and assets are increased with debits, decreased with credits. We want rent expense to go up, so we're going to have to debit rent expense. We want cash to go down. We're going to have to credit cash. And the amount is $510. So there's the first journal entry. I guess technically you would put the date. There's the actual entry, and then you would write a 1-sentence description of what it's for. Paid rent for July or something like that. I'll skip those steps, and we'll just leave it at this right here. Now let's go update the T account. Cash we credited for $510. And then rent expense now is a new T account we have after this transaction. And it has $510 in it. This account didn't exist before this journal entry. But after this journal entry, we now have this new account on the books. Number 2, collected $7,100 on account from customers. This means that customers who we had an account receivable with, they're paying off their account. So they owe us money and they're paying it off. They're paying off their account receivable we have. If you look, beginning of the month, our accounts receivable, beginning of the month, our accounts receivable, $10,700. $7,100 of that is being paid off now. So we want to reduce account receivable. We want to increase cash. So how do we do that? Cash is an asset. We increase it with a debit. Accounts receivable is also an asset, and we want to reduce it because the customer is paying off their account receivable with us. After we get this $7,100, we no longer have $7,100 worth of an account receivable for this particular customer. So they paid it off. We reduce the account receivable with a credit. If we go update the T accounts now, cash gets $7,100 on the left-hand side. Accounts receivable gets $7,100 on the right-hand side. We just keep going. At the end of all these transactions, we will get the final balance in each of these accounts. So the balance at the end of July. And then we'll prepare the trial balance to ensure that debits and credits equal, and also that assets equal liabilities plus owner's equity. Those two things imply each other, though. If the excuse me, if the total debits equal the total credits, then the total assets will equal the total liabilities plus total owner's equity. All right, the next the next transaction, paid $1,800 installment due on the $3,300 non-interest bearing note payable. So we have this note payable. As of July 1st, we owe $4,200 to the bank in the form of a note payable, in a sense, and we're paying $1,800 of it off. So $1,800 of this note payable liability should go down. And to make the liability go down, we're getting rid of cash, so cash should go down as well. So note payable is a liability. To make it go up, we credit it. To make it go down, we debit it. If you recall from the rules of debit and credit for liabilities. So we're going to debit note payable for $1,800. Now cash is an asset. To make it go up, we debit it. To make it go down, we credit it. And we want to make it go down because we're paying off this liability. We're paying off part of this liability. So we're going to credit cash for $1,800. We can go update the T accounts, put $1,800 on the left-hand side in the note payable T account, and put $1,800 on the right-hand side in the cash T account. Might have to have more room here. Let's keep going. Transaction 4, we bill customers for design services that we rendered, and we're billing them on account. So basically, we've done some stuff. We provided some graphic design services for a customer worth $18,100. We've sent them a bill for that. And that's all we did. We need to journalize this. Since we've done the stuff for the customer, we've earned the revenue. Right? Remember up here, revenue is earned when a company provides goods or services to the customer. So we've earned $18,100 worth of revenue. Revenue should be recognized when it's earned. So it's time to recognize revenue. They haven't paid us yet, but we've earned the revenue. So definitely service revenue is one of the accounts. And the other account, it's not cash because they're not paying cash to us. They owe us $18,100. So from our perspective, that's an asset, accounts receivable. We are owed $18,100. So accounts receivable should go up by $18,100, and revenue, service revenue, should go up by $18,100. How do we make accounts receivable, an asset, go up? We debit it. So we're going to debit accounts receivable, $18,100. And how do we make service revenue, which is a revenue, go up? Remember the rules of debit and credit. Dealer, this is an R, it's part of the LOR. And those accounts we make go up with a credit. So we're going to credit service revenue, $18,100. We can go update the T account. We can put $18,100 in the account receivable T account on the left-hand side. And service revenue, that account didn't exist before this transaction, but now after this transaction we have this new account on our books, service revenue, and we'll put $18,100 on the credit side. All right, next transaction. Render design services and collected from cash customers, $1,200. So number 5, we've earned the revenue because we've done the services, but we're getting the cash right when we earn the revenue. It's not like we're sending them a bill and they pay us later. So service revenue is involved and it goes up by $1,200. So we'll credit service revenue for $1,200. And they pay us cash, so cash goes up $1,200. We'll debit cash for $1,200. So it's just like number 4, except instead of debiting accounts receivable, we debit cash. So we'll update the T account service revenue with $1,200 on the right-hand side. We'll update cash with $1,200 on the left-hand side. And we just keep marching right along. Number 6, paid $1,400 to creditors on account. This means we're paying off some of our account payable, $1,400 worth. The two accounts involved are accounts payable and cash. Accounts payable goes down because we're paying it off. Cash goes down because we're having to give up cash to satisfy our obligation. So how do we make accounts payable, which is a liability, go down? Remember the rules of debit and credit. Liabilities are increased with credits, decreased with debits. So we're going to debit accounts payable since it's a liability for $1,800. So it goes down by $1,800, and then we're going to credit cash for $1,800. Make cash go down by, $1,400. And then we'll update the T accounts. So accounts payable, $1,400 on the right hand side, or the left hand side, and the right hand side for cash, $1,400. We're going to need more room. Let's see. Let's give ourselves some more room here. I can remember how to do this. Move that down. Move this down. Hopefully that'll be enough. All right, number 7. Collected $12,750 on account from customers. So they're paying $12,750 of their account receivable off. So cash is going to go up from our perspective, and accounts receivable is going to go down. We can go update the T accounts, $12,750 in cash. $12,750 in accounts receivable over here on the right hand side. All right. Number 8. Paid a delivery service for delivery of graphics to commercial firms. So we're paying shipping essentially. So delivery expense or shipping expense and cash are the two accounts. The delivery expense goes up. We increase expenses with debits. So we'll debit delivery expense for $650. Cash goes down. We decrease cash with a credit. Credit cash for $650. So after this transaction, we have a new account, delivery expense. So we'll write this T account. It has $650 in it. And then we need to update cash as well. A lot of the transactions, as you can see, involve cash, which is good. 9. Paid July salaries, $5,300. This is another expense. We're going to assume that we are deriving the benefit from using the asset. In this case, the employees are the asset, and they've worked for us, and we're deriving the benefit of them working for us right when we pay them, which doesn't usually happen. Usually you pay them after you derive the benefit of them working for you. So salaries expense or wages expense, salaries expense and cash are the two accounts. Salaries expense goes up. Cash goes down by $5,300. So we have a new T account after this salaries expense we need to set up. And we have cash as well we need to update. Number 10. Received the invoice for July advertising expense to be paid in August, $600. So advertising expense goes up $600 and cash isn't involved because it says to be paid. We didn't pay it. So we have a payable to the advertising company. So advertising payable would be the other account. So advertising expense goes up. So we debit advertising expense to show that, $600. And advertising payable goes up, which is a liability. So to make a liability go up, we credit it. So we have two new accounts now after this transaction. We have our, I'm just going to abbreviate, advertising expense. There's $600 there. And then we have our advertising payable. So $600 on the right hand side there. Keep going. Number 11, paid utilities for July, $250. Again, we have another expense, utilities expense. Utilities expense goes up $250 and cash goes down $250. So we'll debit utilities expense for $250, credit cash for $250. We'll set up the new account, utilities expense, new T account here, $250 in it. And then cash, we need to go update cash, put $250 on the right hand side. We're running out of room over here in cash. Gonna have to move these down even more. Number 12. Paid stockholders a dividend of $2,000 cash. The two accounts involved are dividends and cash. Cash goes down by $2,000 and dividends go up by $2,000. Dividends are a D, right? D-E-A-L-O-R. Dividends are D. We make those go up with a debit. So we're going to debit dividends for $2,000. Cash is an asset. We want it to go down, so we credit cash $2,000. And we need to set up the dividends T account now. And we go update cash. Number 13, we're almost done with the 14 transactions. Received invoice for supplies used in July to be paid in August, $22.60. Now this one's a little tricky, the wording. So essentially what's happened is two things have happened, but they're wanting you to summarize it in one journal entry. Let's do two journal entries, though, because it'll make it make more sense. But you'll see that the two journal entries, when they net out, you just have one, essentially one, you can make one journal entry to show the net effect. So let's first take, we bought supplies for $22.60, but we didn't pay for them. So we have an account payable. So that journal entry would be supplies would increase. Supplies is an asset, it goes up with a debit. And account payable would increase. Account payable is a liability, it increases with a credit. So that's that journal entry. And then during July we use these supplies up. So we have this dollar amount of supplies in our supply room, and then we actually use those supplies and we use them. We use them up. We use the markers and pens and paper, whatever these supplies are, we use them all up. And so the journal entry to show that we've derived the benefit from the asset, and you derive the benefit of the supplies when you get to use them, is we need to recognize the expense, right? Supplies expense, debit 2260, and credit supplies 2260. And so what they want you to do here is just do one journal entry. If you look here, we debited supplies for 2260, and then we credited supplies for 2260, and so that kind of nets out to zero. And so really all we've done is the net effect, what they want you to do from these two journal entries is just debit supplies expense for 2260 and credit accounts payable, because that's the net effect of the two entries. But in reality, this is what you would do as the company, because you first get the supplies. This happens first in time, and then later in time, this happens. But what they're assuming is that these two things happen at the exact same time instantaneously. And if that's the case, then this would be the entry. We'll see, though, in Chapter 3, we'll do it from this perspective, where these two things happen at different moments in time, which is which matches reality for most companies. So what they want, though, is for this particular problem is this journal entry right here. So supplies expense, let's go update accounts payable 2260. And then we have this new account, supplies expense. We haven't created that expense yet, so let's go create that T account. And we'll put 2260 on the left-hand side. And then finally, let's do 14. Purchased computers for $7,000 cash to be used in the business starting next month. This is an easy one. Two assets involved are computer and cash, or the two accounts involved, computer and cash. But usually, computer is just part of equipment. So we'll just call equipment and cash. So equipment goes up. We'll indicate that with a debit to equipment. Cash goes down. So we'll credit cash. So we'll update the cash account, 7,000. And equipment, it's a new asset we now have. We need to set up a T account for that asset, and it has 7,000 in it. And so after doing these transactions, so assume that this is all that happened in July. Now we've reached the end of the month. Now what we need to do is find the ending balance in each of the accounts. So the accounts that we only have one entry in, that is their ending balance. So all these accounts, their ending balance is pretty, well, service revenue here we have to, 18,100 plus 1,200 is 19,300. So the ending balance in service revenue is 19,300, and we double underline the ending balance. And then over here, looks like note payable started with 4,200. We paid off 1,800 of it. So it has how much left? If we do some mental math, if we had paid off 2,000, it would have 2,200 left. But we've only paid off 1,800, so it's 2,400 here. We still owe. Ending balance in note payable is 2,400. Ending balance in accounts payable is, let's see, 2,100 plus the 2,260 minus the 1,400. So this is 4,360 minus 1,400. Well, if it was 4,400 minus 1,400, then that would just be 3,000 left. But it's 4,360. It's 40 shy of 3,000. 2,960. Ending balance in accounts payable. Of course, you can use a calculator, but I like to do it mentally because it's good practice. However, for these two, maybe I'll just use a calculator to make it go faster and ensure that we don't make any mistakes. So let's see, where can I? Here we go. So for accounts receivable, we need to update our 10,700 plus 18,100 minus, come on, minus 7,100 minus 12,750. So 8,950 is the ending balance in accounts receivable. And then finally cash. In here, I'm probably going to have to move, just to be able to write the ending balance, I'm going to have to move something down. Let's see, where can I move down? I can move this down here. All right, ending balance in cash. We know it's going to be an ending debit balance because cash has a normal debit balance. We have to add 6,800. Let's see. Come on. 6,800. Can't get this thing to go up to the top. Well, maybe I could just do it this way. 6,800 minus 510 plus 7,100 minus, whoops, not 7, minus 1,800 plus 1,200 minus 1,400 plus 12,750 minus 650 and then where did my calculator go? Minus 5,300 minus 250 minus 2,000 minus 7,000. Oh, I didn't have it. Dang it. So minus 650 minus 5,300 minus 250 minus 2,000 minus 7,000. So 8940 it looks to be. So it ends at 8940 the month of July. Excuse me. So now we have the ending balance in each of the T accounts. Now we can prepare a trial balance. Trial balance, we list each account and its balance. We start with debits first and then we do credits, with the exception of we want to keep the revenues and the expenses together. So let's just walk through this here. We'll start with cash and its balance, according to our calculations, $8,940. So I'll put debit here. Counts with debit balances, counts with credit balances. After cash, we'll do accounts receivable. Its balance was at the end of the month $89.50. Let's see, what else do we have here? Do we have any other assets? We want to list those. We have our equipment, 7,000. And then what we're going to do for our expenses, yes, they have debit ending balances, but we're not going to put them next because we want to put the expenses right underneath the revenues, just to keep, it makes it easier. It facilitates an easier preparation of the income statement because the income statement summarizes revenues and expenses, and you can grab those if the revenues and expenses are right next to each other, or one right underneath the other one. You can grab those and prepare the income statement. So next we'll go with our credit account balances because I think we're done with all of our, well, there's supplies account. Now the supplies account we put 2260, then we took 2260 out. So there's nothing in the supplies account. I guess dividends. We could put dividends here. All right. Now let's go and do our liabilities, our credit account balances. So account payable 2960, note payable 2400. And then we have our advertising payable. We'll do our revenues last. We have our advertising payable. We have common stock and retained earnings. Any other payables here? Let's see. So advertising payable, common stock, retained earnings. And then we'll put our revenues, and underneath that our expenses. So let's see, advertising payable, common stock, and retained earnings. Advertising payable has 600 in it. Common stock has 2,000. Retained earnings has 9,200. 600, 2,000, 9,200. And then we're going to list our revenues. Our revenues are, let's see, we have our Service revenue 19,300. Is that our only revenue? I think that is. Yeah, service revenue 19,300. And then our expenses. We have supplies expense, utilities expense. So I'll just write those here. Supplies expense. And there's 2260 in it. Utilities expense. Advertising expense. Wait, salaries expense, if you recall. All right, let's go and get the numbers. Utilities was 250. Advertising was 600. Salaries was 5,300. Were there any other expenses? Let's see. Delivery expense 650 and rent expense 510. And now we can ensure that our total debits equal our total credits. So if we take a calculator and we add up all the debits and then get the answer, let's clear that, and then do the same thing for the credits, we should get the same answer. If we don't, then we've made a mistake somewhere. 8940 plus 8950 plus 7,000 plus 2,000 plus 2260 plus 250 plus 600 to 300, 510, and 650. 36,460. And on the credit side, we have, let's see, we have 2960 plus 2400 plus 600 plus 2000 plus 9200 plus 19300 and 36,460. Thankfully, we get the right answer after all of that. So you see the total credits equal the total debits. Now, this does not ensure 100% that you didn't make an error. For example, we could have made an error. We could have debited an account for $100 more than we should have debited it for. But then if we credit another account for $100 more than we should have credited it for, the debits and credits are still going to equal each other, but we've made an error. But in general, if the total debits equal the total credits in the trial balance, you probably have not made an error. So the total debits equaling the total credits in the trial balance is a necessary but not sufficient condition to ensure that you haven't made an error. You still may have made an error, but likely you haven't if these two equal. Anyway, that concludes this problem.